dangerously close to an area which caused a little bit of turbulence in markets before. Do we, shrug it off because it's all coming from the 10 and, not the Fed hiking us into recession, or what, Larry?
I wouldn't necessarily shrug it off, but I'd put it in perspective. I mean, keep in mind, UK, Japan came back from the holiday, added, insult to injury, getting bonds higher, and we came dangerously close to the lows that we've seen over the last few weeks. Combine that with the fact that I think the market's overly pessimistic on the inflation front, looking at that 1.55 PCE core number, when there's a lot of metrics beneath it that really don't support it. So I think it was one of those things where Treasury yield just followed stocks and commodities today. Investors got caught with their eyes rolling from being too complacent about things since the weekend.
Yeah, we had a very short-lived now couple of weeks where the yield curve expanded, a month basically, the month of April.
Yes,
and now
I felt it.
Yeah, and then and then overall though, you take a look at the long-term chart between that spread, and it seems undeniably trend-like in fashion, Larry. I mean, do you put any emphasis into, momentum in this type of analysis, or what? Do you want to jump in front of this train and start shorting bonds? I mean,
yeah, no, I wouldn't do that right now. Although I do think short-term we are a little bit overly pessimistic, and there is a room for a bounce back, as it were, in the 10. When it comes to the yield curve, if you notice, when we got up to the year-to-date highs around 21, 22 basis points, there's a lot of pressure on that. It had a hard time getting above that, and it also had a really hard time getting down to 9. That's where I wanted it back when we were flirting with like 13 in the 210 spread. So I think a lot of it is going to play out with regards to the trade deal. I mean, that's a lot. I mean, right now, as we mentioned, 10-year yields are only 4 basis points above effective fund rates, and I think that's very telling. I think that's saying there's going to be a protracted, laborious, problematic non-deal come Friday.
All right, so you've got now 2 events Friday. This is going to be a busy day. One is the implementation, we've been told, of the higher tariffs. The other is going to be your inflation read. You've got PPI before that. How do you as a trader want to approach that? Can you give me an idea how you're positioned in bonds, or what you think is going to be a good way to come into this event-driven day?
Yeah, great question, because between now and then, I think it's all going to be about cross-asset correlations, et cetera, and I would just trade it that way and just keep it much smaller than you're normally used to trading. No matter what your size is, I would cut it at least in half, if not by a third, and just wait, let it play out, because these moves can be violent and dangerous. And just what we saw in the stock market between Sunday night and today. I mean, it's just amazing what's happened. So I just not a good time to be a hero. You just stand back and just watch.
Now, is there then, when you see so many days, Larry, in which there's the bid in bonds regardless of the news flow, right? I keep coming back to the fact that we had a strong day for bonds on the GDP beat, a strong day for bonds on the employment beat, because the market still interpreted it as an inflation, lacking event. That means Friday, and by the way, we still get a bid as a safety haven on a day like today. So in terms of Friday, do we think that, do you have to have a really strong view on like some massive beat for inflation for there to really be any kind of relief to the bond rally?
Not really at this point, looking more at levels. I mean, if they're going to continue to trend higher, I think like 2.338 would be a level where I would turn around and perhaps get short. All that to say, it's going to be very fascinating to see what happens, because there is a natural bid. We have a big refunding auction tomorrow in the 10s. That's going to be telling as well. But as long as we have the enormous interest rate differential that we have between us and the G10, bonds are going to remain bid, and there's going to be a lot of buying of the dips. So when we see us get back up to 2.6, if we do get back up there, it's just a natural place to get long, because there's just so much buying interest there, solely predicated on the interest rate differentials.
Yeah. Okay. So we got a busy day coming to us this week, Larry. Is there, last point here, I know I said that again, but is there a bottom that you see within the 10-year? Is there a certain point, though, with the health of the economy, that it's just going to have a floor, or is that a fool's errand at this point?
Yeah, I think the floor might be two spot 338, given that the local low for the year. But that said, I think it's almost, and what I said earlier about the whole 10-year trading 4 over the effective fund rates. I mean, I think that's pricing in a insurance cut, and that's something that the Fed's going to have to do at some point, especially if this breaks down on Friday. And that's what the market's telling us right now. Is it's giving us that hint. The sell-off we have in the stock market's much bigger than the evaluations would say. I mean, right now, it's amazing because $181 per share, that would get us at $2,900, when in actuality, earnings per share are closer to $184 a share. So all that to say, I think it's just pricing in a insurance cut for the wrong reasons, and that's why the stock market's reacting the way it is, and the way bonds are trading the way they are right now.
Yeah. All right. Larry Shover, great stuff. Nice hit, an important one today on the bond market. You got it, sir. Mr. Shover is the CIO at Efficient Advisors. We'll be right back. More volatility talk. We got 3 charts on VIX and more when we get back. Stick around. Andy Thrasher is going to join us right after a short break.